Best Bull Market ETF Investing Strategies and Key Takeaways. Part 5 of 6. What if I told you that bull markets are where many investors make their biggest mistakes? Not because the market is falling, but because it's rising. Sounds backward, right? Yet every bull market creates a fresh batch of investors who become convinced they're financial geniuses. When everything is going up, almost every decision feels smart. Even bad decisions get lucky for a while. And that's exactly the danger. Bull markets can quietly convince people that risk doesn't exist anymore. People start chasing hot stocks. They start buying whatever everyone else is talking about. Suddenly, everyone's cousin is an investing expert. The problem is that bull markets don't last forever. Eventually, the party ends, the music stops, and somebody discovers they paid way too much for their seat. So what should investors actually do during a bull market? The answer is surprisingly boring. And boring is often where wealth gets built. Welcome to the Simply Speaking About Money video channel. It is here where we talk about budgeting, saving, and investing in the real world of probabilities, and not the crazy hype, noise, and lottery-like promises of possibilities. Today, we'll discuss some of the best ETF investing strategies for bull markets and the key lessons every investor should remember before the next market cycle arrives. Let's start with the first strategy. Stay diversified. Yes, I know. Diversification is about as exciting as reading the instructions before assembling furniture. But just because something is boring doesn't make it ineffective. In fact, diversification may be one of the most powerful tools investors have. Instead of trying to guess which company will be the next superstar, diversified ETFs spread your money across many businesses. One example is a broad market ETF. Funds like VTI or VUO give exposure to large portions of the US stock market. Could one individual stock outperform them? Absolutely. Could it also crash spectacularly? Absolutely. That's the part people conveniently forget. Broad market ETFs focus on probabilities. Stock picking often focuses on possibilities. One approach builds wealth consistently. The other makes for exciting YouTube thumbnails. Strategy number 2 is continuing to invest consistently. This becomes surprisingly difficult during bull markets. Why? Because investors often start waiting for a correction. They tell themselves they'll invest later when prices come down. Sometimes those lower prices never arrive, or they arrive years later after the market has already moved much higher. Trying to perfectly time a bull market is like standing at a bus stop waiting for a better bus. Meanwhile, several buses have already taken other people to their destination. Consistent investing removes the guessing game. You invest according to your plan rather than your feelings. Feelings are wonderful for choosing pizza toppings. They're often less helpful when managing investment portfolios. Strategy number 3 is resisting performance chasing. This is one of the biggest bull market traps. Investors see a sector that's been soaring. Technology, artificial intelligence, whatever happens to be making headlines. Then they decide all their money should go there. Because obviously, what went up yesterday can only continue forever. That's definitely how markets work. Except it isn't. History is filled with sectors that looked unstoppable right before they weren't. A disciplined investor understands that recent performance doesn't guarantee future performance. It's a warning label for a reason. Instead of chasing yesterday's winner, focus on building a balanced portfolio that can survive different market environments. Strategy number 4 is rebalancing. This is one of the most overlooked habits during bull markets. Imagine your target allocation is 70% stocks and 30% bonds. After several years of strong growth, stocks might grow to 80% or even 85%. Without realizing it, your portfolio becomes riskier than you originally intended. Rebalancing brings things back into alignment. It forces discipline when emotions are trying to take over. Think of your portfolio like a vehicle. The steering wheel may drift over time. Rebalancing is simply correcting your course before you end up in a ditch. Now let's talk about one of the most important bull market lessons. Do not confuse a rising market with investing skill. During strong bull markets, many investors believe every decision they make is brilliant. The market often humbles those assumptions later. A rising tide lifts almost every boat. Some people mistake the tide for personal genius. The goal isn't to look smart during a bull market. The goal is to remain successful after the bull market ends. That's why long-term investors focus on process rather than predictions. A good process works in both good markets and bad markets. Here's an analogy. Imagine building a house. You don't design the foundation based on tomorrow's weather forecast. You build a strong foundation because storms eventually arrive. Your portfolio should work the same way. Bull markets are wonderful. They grow wealth. They reward patience. They make investing feel easy. But they also create overconfidence. And overconfidence has emptied many portfolios over the years. The best ETF strategy during a bull market is surprisingly simple. Stay diversified. Invest consistently. Avoid chasing performance. Rebalance periodically. Notice what's missing from that list. No crystal ball. No secret formula. No magical prediction machine. That's because long-term wealth is usually built through discipline, not excitement. The market rewards patience more often than brilliance. If you remember only one thing from today's video, remember this. Successful investing is about probabilities, not possibilities. Thanks for watching Simply Speaking About Money. If you found this helpful, please like, subscribe, and check out the links in the description for tools and resources that may help simplify your financial journey. And remember, build wealth using probabilities, not possibilities. Once your budget is working and you've started investing, the next step is optimization. That's where Betterment comes in. Betterment is an automated investing platform that builds and manages a diversified portfolio for you. It handles rebalancing, tax-efficient strategies, and long-term planning, so you don't have to. You don't need to time the market. You don't need to pick stocks. You just need a strategy and consistency. If you're serious about growing wealth the smart, disciplined way, check out the link in the description to get started with Betterment. Affiliate disclosure. I may earn a commission if you sign up using my link at no extra cost to you.